Pratibha College of Commerce and Computer Studies organizes a course on awareness on financial investments. I'm Professor Mihir Jagtap and I will take you through some basic aspects of investments in financial markets and with that the basic structure of financial system and trading in securities. So welcome. So in this module we will discuss about the Indian financial system and its role in mobilizing savings and how traders or speculators or investors, uh, what are the different avenues for them in order to invest in the market? How does the trading in securities uh, actually happen in the financial market? To begin with, the financial markets are basically classified two groups as such: money markets and capital markets. Money markets are the markets where money markets instruments are traded, which are of short-term nature, which has maturity of less than 1 year. And in capital markets, those instruments are traded. The maturity of those instruments basically is of long-term nature. Uh, Money market comprises of organized banking, unorganized banking, and sub-markets, whereas capital market in capital under capital market we can look at development financial institutions, financial intermediaries, and securities market. So coming to the development finance institutions, uh, these are some of the finance institutions, development finance institutions. Basically, the finance institutions can be divided in two types of institutions. One are development finance institutions like IDBI, IFCI, ICICI, okay, and the other type would be like investment institutions like UTI, LIC, and GIC. They provide finance to the entrepreneurs and businesses, technical guidance on projects on all India level. They lend money to projects in the backward regions at concessional rates, etc. They are the major players in the capital markets. They provide loans and advances to industrial units. They invest in their equity shares, provide seed capital to these small businesses. They underwrite shares and debentures and other instruments. So these are the functions basically of development finance institutions. And other types of institutions are where the retail investors also can invest or put their park their money in, are Unit Trust of India, Life Insurance Corporation of India, General Insurance Corporation of India, etc. Coming to the financial other aspect, the financial intermediaries. The financial intermediaries are merchant bankers, mutual funds, leasing corporations, and venture capital funds. The venture capitalists basically uh, take the money from the investors and invest their money basically in different, you can say, uh, in the companies of the small scale entrepreneurs who are aspiring but don't have capital, don't have sufficient capital, but have a business plan and they want to set up projects, etc. That's how venture capital fund operates, and they will take the money and invest into certain projects, and the profits will then get distributed accordingly. Coming to the stock markets, one of the important aspects, or the one of the important components, one should say, of stock markets is stock exchanges. Uh, A stock exchange is a body constituted for the purpose of assisting and regulating or controlling the transactions regarding the purchase and sale of securities. The major stock exchanges in India are the Bombay Stock Exchange and the National Stock Exchange, NSE. Here, the investors can come together and trade in various securities. So these are the places where the transfer of ownership in stocks can happen. Even if you consider the entire economy, the stock exchanges have a significant importance. So stock markets basically have significant importance or significance in that aspect. They provide liquidity to the stocks of the listed companies, the companies which are listed in the stock market. These listed companies can be government corporations, private corporations, or semi-government corporations. That is to say, public limited companies or semi-government organizations that they are able to raise funds here. The public limited companies which are listed in the stock market, they are able to raise funds here. The savings are mobilized into investments through various financial assets, but these financial assets can be exchanged in the stock markets. So this basically carries out the process of transfer of ownership of the securities, and it makes easy, this process becomes easy, transfer of ownership from one entity to another entity. Coming to the capital markets. Capital markets are basically, you can say, divided into two types of markets. There are two different types of operations that happen in the capital markets. That is primary market and secondary market. The primary market is also called new issues market. Whenever a company wants to issue its share for the to the general public for the first time, it can do that through the primary market. The IPO is initial public offer. When a company wants to raise funds from the stock market, it gets listed on the stock market and issues equity to the public for the first time through an IPO. The primary intention of bringing an IPO into the market is to raise capital through public offer. In this process, both equity and preference shares can be issued. Another type of offer like IPO, we can also have FPO. So FPO is follow-on public offer. Follow-on public offer means when a publicly listed company subsequently issues its share to the public, it can do this through an FPO. That means the company is already listed into the market. Even then, it wants to issue equity shares. Now, why would it want to do so? The basic intention here is to dilute the equity base of the company or diversify the equity base of the company. So even if the company is listed into the market, in order to diversify its base, the company will bring about a follow-on public offer. This happens through primary market. In the secondary market, there is trading of existing securities. For example, once a corporation, once let us say a public limited company issues its shares to the public, the retail investors who buy those shares, they can trade those shares amongst themselves in the secondary market. So whenever there is, let us say, a public limited company issues the shares, private corporations cannot issue their shares to the public as such, but private companies, that is to say, but the uh, public limited companies in the private sector, okay, they can issue such shares through primary market. Uh, but those shares which are issued in the primary market, once the retail investors acquire those shares, they can trade those shares in the secondary market. Thus, the transfer of ownership from one retail investor to another, one individual to another, uh, becomes easier. Coming to the markets, there are different types of markets uh, in a stock market. There is, let us say, an equities market, a bond market, currencies market, and a commodities market. In equities market, the equities of the corporations uh, are traded. That is to say, shares, equity shares of the corporations are traded. Uh, in the bond market, the bonds are traded. In the currency market, the currencies are traded. That is to say, let us say, Indian currency, US dollar as to the Indian rupee. The trading of these currencies happen in the currencies market, and further there is a commodity market. This market is specially designed for uh, trading in the commodities like let us say oil or wheat or and likewise. So these are basically uh, the sections of the uh, market, if you can say. Further, it can be divided as a spot market, and we can look at the markets like this also, like spot market and derivatives market. So what is the spot market and what are derivatives basically? These are a little bit initially when you look at it, it looks complicated, but these are basically simple concepts if you understand it properly. The spot market is a market where the financial instruments such as commodities and currencies and securities, various securities are traded for immediate delivery. So immediate delivery means, let us say, in a spot market, which is a place where the securities are bought and sold and money is exchanged on the spot. Okay, that's why it is called as a spot market. For example, if person A wants to has shares of, let us say, Steel Authority of India Limited, and he wants to sell those shares. Let us say 1000, he has 1000 shares and he wants to sell those shares. And person B is willing to buy those shares at the given market price. So the exchange here would be the person A would give shares to person, that is to say person B will buy the shares from person A and will pay the money. Okay, so that transaction will happen on the spot. This of course happens through a brokerage house, not directly, but this entire transaction takes place in a uh, stock exchange or exchange where the this transaction happens through the brokers. Now the brokers who facilitate this transaction charge certain amount of commission that is called brokerage, and so that is their main business, basically to facilitate this transaction in a stock exchange and or a stock market. That is to say, where the buyers want to buy the securities and the sellers want to sell those securities. This transaction is facilitated through brokerage houses. they charge their brokerages on various transactions, on each transaction, and they have variable rates of those brokerages. For let us say some brokers will charge for intraday trading for trading purpose, let us say 0.1% of the entire 0.10%, let us say, of the entire transaction cost. Some brokers will charge 0.25%. For delivery based trading, or for buying the stocks for the purpose of taking delivery, the brokers might charge, let us say, up to 0.5% of the total transaction value. So these brokerages are variable depending on the different brokers. But point is that these transactions happen uh, in the in these markets, spot markets. Not to confuse it that the brokerages don't work in derivatives market. They also, I mean, they charge brokerages and all kinds of transactions. It doesn't matter whether it is spot or derivative. So basically, what is a derivative market? A derivative is a contract that derives its value from the underlying security. There are two types of derivatives: exchange traded derivatives that are traded in the stock exchanges, and there are other derivatives which are not traded in the stock exchanges, that are called as over the counter derivatives. So a derivative is a contract which derives its value from the underlying security. So it is not a real security in nature, it is derived from the original security. Exchange traded derivatives are standardized contracts that are traded basically on the centralized exchange, and OTC means over the counter derivatives. They are not traded on the exchange. That is to say, they are traded outside the exchanges. Now, there are primarily four types of derivatives. One is swaps, other is forward contracts, another one is futures contract, and further the options contract. In this module, I will give you a brief introduction about the futures contract and the options contract. So what is a futures contract? Futures contract is a contract between two parties to buy or sell an asset at a certain future date, at a certain future price for that particular underlying asset. So let us say a person has a particular asset or a particular commodity, or let us say shares. He will trade those shares. He will either sell those shares at a particular future date, at a particular future price. Okay, so that is a futures contract. So in a futures contract, parties are entering into the contract, parties that are entering into the contract, since I told you that derivatives are those assets which are derived from the original assets, so that they are not real assets as such. So those parties which are entering into the contract here, the buyers or the sellers, need to pay an initial margin amount which is a fraction of the total contract size. So therefore, they need not pay the entire amount of the contract. So they just have to pay a fraction amount of the total size. Uh, so and the respective parties are then paid the difference between the base price and the settlement price. So that would be the if the difference will be the profit or loss, whatever it can be. Okay, so in this case the investors can also square off the position before the settlement date. So if the future contract is this, let us say the settlement date is 3 months or 2 months, the respective party can settle the contract, let us say in 7 days also, or 2 days also, or immediate, or let us say after uh, 3 hours also. Okay, so that is they don't have the obligation that they need to wait for those 3 months till the future date. If he fails to do square off the position though, let us say the contract is for 1 month and the person fails to square off the position, then it will get squared off automatically. Coming to the options contract. An options contract is a contract between two parties to facilitate a contract at a present price, which is basically called a strike price, before the expiry date. Now, in case of options contract also, there are two types. One is a call option and another is a put option. So what is a call option? A call option, basically this contract gives a buyer a right to buy, but not an obligation to buy a specified amount of underlying securities at a particular strike price before the expiry date. Okay, that means the buyer of the call option has a right to buy a particular security, but he is not obliged to buy that particular security. If he is having a loss on that particular security, he need not buy that. Okay, on that particular day. So that is to say he has a right to buy, but he does not have an obligation to buy. So that sort of arrangement is called as a call option. The put option, on the other hand, is exactly opposite to that, opposite to this. Opposite in a sense that this contract gives the buyer a right to sell, not to buy, right to sell the underlying security, but not an obligation to sell. Again, uh, uh, the same thing here. This contract gives a buyer a right to buy, but not right to sell, but not an obligation to sell a specified amount of underlying security at a strike price before the expiry. So in case of put option, the uh, buyer uh, uh, has a right basically to sell that particular security. Uh, so he has a right, but not an obligation to sell. These are some basic aspects about futures and options market. Now I will take you through some of the major stock market indices uh, in India. They are NSE Nifty, BSE Sensex, BSE Small Cap, Mid Cap, and Bank Nifty. So what are these? NSE Nifty basically is a benchmark index that represents a weighted average of 50 largest companies listed on NSE. That is to say, uh, 50 largest companies in terms of market capitalization. Sensex, on the other hand, this Nifty is regarding National Stock Exchange. Sensex, on the other hand, is a benchmark index that represents 30 well-established and financially sound companies on the Bombay Stock Exchange. In the initial part of this lecture, I told you that these two are the major stock exchanges in India, NSE and BSE, National Stock Exchange and Bombay Stock Exchange. BSE small cap, another index is, there are many funds, many indices, BSE small cap and mid cap are also amongst them. Another example is Bank Nifty. So Bank Nifty basically represents 12 largest companies in the banking sector, especially in the banking sector, in terms of market capitalization that are listed on the National Stock Exchange. So it is basically this index comprises of the 12 largest companies in the banking sector uh, in terms of market capitalization and its index. So that index is called as the Bank Nifty. Now coming to so this is something that I told you about trading. Okay, trading in securities. Certain aspects about trading in securities or investing. Now again, the question here is, there are two aspects. There are certain people who want to trade in securities not for the purpose of investment, but for the purpose of speculation. And that's why the general perception is that the investment in stock market is risky, because the stock prices or the asset prices are volatile, and maybe in many cases it has happened in the past that some uh, fraudulent behavior is also committed in the stock exchange, stock markets. So, but the real essence here, which I want to tell you, is that the stock market is a very good place to invest also, where the majority of the transaction happen for investment purpose also, not just for speculation, but for investment. And so this speculative, what you can say, speculative trading and these aspects might scare away the actual investors who want to invest the money in sound companies, sound corporations which have sound fundamentals. That is done to do that. Basically, the government has to bring to provide some sort of confidence into the minds of the investor, uh, so that the investor protection, uh, to provide investor protection, basically, the government of India set up an organization called Sebi in the year 1988. Sebi is the full form is Securities Exchange Board of India. Sebi was set up as a developmental and regulatory body for securities market in India in the year 1988. The objective, the major objective of Sebi is to ensure investor protection so that there is steady flow of savings in the capital market. Just as I told you that the actual investor should not uh, run away from the market or get scared due to fraudulent behaviors of certain individuals or companies. So they to ensure basically investor protection. Further, so that is the basic objective of SEBI, basic role of SEBI. Further, to ensure the fair practices by the issuers of securities. So the same thing that I am talking about, that whichever the parties that are involved in transaction, uh, the transaction has to be fair. Further, the promotion of efficient services by intermediaries like merchant bankers, basically, who underwrite the securities, and other intermediaries also, brokerage houses, etc. So, to the promotion of efficient services uh, by them. Further, uh, the the fourth aspect or another aspect would be the regulation of activities like underwriting, listing of shares, etc. in the securities market. So these are the objectives of that. With these objectives, the Securities Exchange Board of India was set up. Next, coming to the basically, so this is about the investment part, which I discussed with you. That what are the investment avenues and how the capital markets functions, what are the what is primary market, what is secondary market, how trading happens in the primary market and secondary market, speculation and investment also. And here we are discussing about the investor protection also through Sebi. Certain aspects which are preliminary to trading in the stock exchanges is that if one wants to trading in the stock market basically is to that the investor needs to have some, let us say person X wants to buy shares of some corporation, let us say Steel Authority of India or Tata Motors. First of all, he needs to register with a broker. He needs to have a demat account, which will do dematerialize, that is to say, which will carry out the dematerialization of the shares in the electronic format. So whatever the shares are purchased for the delivery purpose, let us say, they will be there in the demat account. Another aspect, I told you about the brokerage, but another aspect about trading is once the trade happens, that is to say, sell and buy and sell, the subsequent contract notes also will be produced. So those contract notes and those documents will be with the investors. They will be given to the investors immediately. The settlement of deliveries, I told you about the intraday trading and the delivery based trading. So in case of a delivery based trading, the settlement of the transaction will happen in T+2 days. T+2 days means if the transaction takes place today, transaction of buying and selling of securities takes place today, the settlement will happen in 2 days time from today. So these are some of the aspects, and the funds will be transferred to the account of the investors, respective investors, in 2 days time. So exchange of securities and funds will happen in 2 days. So that is called as T+2 settlement. Coming to the this perception we were discussing about, that the people have layman person, anybody who doesn't have in-depth knowledge of finance is generally afraid of investing into the stock markets, because one part is correct that there are some genuine risks that are also involved in this entire process. As a rule of finance, the higher the risk, the higher will be the return. For example, if you purchase a debt instrument which has a fixed income, your investments will be more secured, but the return will be lower. Whereas if you prefer to buy equities in the market, the returns might be higher, but the risk involved is also greater to that extent. So the higher the risk, the higher the return. The risk is that you might lose the entire capital if the company is not let us say operating under fraudulent means, as happened in the case of Satyam, for example. Or the risk is that the company may not, okay, the company might be a genuine company, like let us say Tata Motors or others, let us say, but they might not perform particularly well in a particular period, so the returns might be lower. So therefore the this risk is always there in case of equities market. So let us say, as I told you, the risk, the rule of finance, higher the risk, higher the returns. In a fixed deposits, you might get a safer return, but the return will be lower. Let us say 6%, 7%, 7.5% interest on a fixed deposit. In equities, if you buy equities or shares of a particular corporation, you might get 13% return or 15% return. But to that extent, you have to bear the risk also. So this is about, so talking about risks, there are primarily two types of risks, uh, uh, systematic risk and unsystematic risk. So what are these? Systematic risks are inherent to the entire market. That is to say, they are not limited to a particular sector of the economy. Let us say aviation sector, that is not the case. If these risks are inherent to the entire market, all the sectors in the economy, they are unpredictable and are difficult to avoid. Even for seasoned investors, it is very difficult to avoid these systematic risks. And these risks cannot be mitigated through diversification also. So to give you an example, let us say interest rate risks or risk of recession or inflation, or a war might break out, okay, with some other country, okay. So this will affect the entire market, not a particular segment in the market. So these risks are systematic risk. There are another type. So the point here is, no matter how you diversify your portfolio, uh, the if war breaks out, it will affect all the sectors in the economy, all or the companies in all the sectors in the economy. So therefore, these risks cannot be avoided. There are certain types of risks that are called unsystematic risks, which are unique to a specific company or specific industry. Let us say aviation industry. Okay, so those risks are predictable and they can be mitigated through diversification. For example, if there is some trouble in aviation sector, you can an investor foresees this problem, that the profitability in the telecom sector or profitability in the aviation sector will be lower in the future. He can sell the shares in his portfolio if he holds the shares of the telecom companies or aviation companies, or companies in aviation industry, and he can buy the some other assets. Okay, so he can diversify his portfolio and mitigate this unsystematic risk. So this is just a in this lecture I try to give you a brief account of the structure of the capital market, trading in securities, and some basics of risks that are involved, uh, like systematic risk and unsystematic risks. Thank you very much.